Welcome back. This is Aaron Parrish with Triad Financial Advisors. In this video, we're going to be going through how to evaluate when to apply for Social Security, as well as when penalties and taxes will sometimes apply to this income. The two biggest factors to consider are your health and life expectancy. Most Social Security strategies involve you foregoing a lower amount of income today so that you can receive a higher amount of income at a later date. But you need to have a certain amount of life expectancy to receive that higher amount of income to make up for the lost income in the early part of the strategy. If you have a health event that changes your life expectancy, it may be best for you to go ahead and file as soon as you can so that you can begin receiving money, because you may not have as much time to receive that higher income if you delayed. Some other things to think about: do you need the income now, or do you have other assets that you can tap into so you can forego tapping Social Security income so you can get that 8% increase? If you need the money now and you don't have other options, you may be forced to take that money now. We're going to get into this in a little bit, but if you are working before full retirement age, there could be some penalties that come along with this. And finally, survivor needs. Don't think about it just in terms of the benefits you'll receive over your lifetime, but also over your spouse's potentially. We talk with this a lot with clients that someone says they don't think they're going to live long enough to delay their benefits and fully reap the rewards, but they have to think about their spouse as well. If they were a lower earner, the higher earning spouse should really consider delaying their benefit, because that'll carry on for their lifetime as well as their spouses, even if they do pass away prematurely. If you apply early, your benefit's going to stay lower for the rest of your life, so that's going to severely reduce the amount you receive over your lifetime if you have a long life expectancy. There are cost of living adjustments. Social Security increases with inflation, so if you delay your benefit and get that 8% increase, these cost of living adjustments are going to compound and magnify that difference and just make it that much more powerful to delay. And as I mentioned previously, delaying is going to benefit you as well as any survivor benefits that your spouse could receive. Social Security has a few penalties when it comes to working and receiving Social Security income before full retirement age. Starting in the month that you reach full retirement age, you can earn as much money as you want to while receiving Social Security income. But if you are younger than full retirement age and working while receiving Social Security income, that's when certain rules and calculations will apply. So before full retirement age, for every $2 that you earn over $15,720, Social Security is going to reduce your benefit by $1. So if you earn too much money and you filed for Social Security income, they may actually reduce your entire benefit if you earn too much money. Now, it's not gone forever. You will receive that back once you reach full retirement age, not in the form of a lump sum, but they will recalculate your benefit at 66, and then they will spread that out over your life expectancy. So you'll get a little bit higher amount each month, so that by your life expectancy, you will have received back that money that they reduced your benefit by previously. And in the year that you reach full retirement age, from January until the month that you reach 66, it's going to be a different calculation. It's going to be $41,880. For every $3 that exceed that amount, they're going to reduce your benefit by $1. And then once you reach the month that you turn 66, it does not matter. At that point, no calculations will apply, so you don't have to worry about this. Social Security receives some preferential tax treatment. So in North Carolina, there's no state income tax applied to Social Security income. And from a federal income tax standpoint, the maximum that could ever be included as taxable income is up to 85%. So there will always be 15% that you don't have to pay income tax on. So let's focus on the married filing jointly row here. So under $32,000 of provisional income, you could potentially not pay any federal income tax on this Social Security income. Provisional income is going to be your adjusted gross income plus 1/2 of your Social Security benefit, as well as any tax-exempt interest, which would be municipal bond interest. If your provisional income is between $32,000 and $44,000, Up to half of your Social Security benefit could be included as taxable income, and if it's over $44,000, up to 85% of the Social Security income could be included as taxable income. One potential way to reduce the amount of tax that will be applied to your Social Security income is to pull from your Roth IRA accounts. Anything coming from a Roth IRA will not impact the provisional income figure on the previous slide. You should also be aware of the required minimum distributions that will be applied to your qualified accounts. This could easily push you over the threshold and force you to include up to 85% of your Social Security income as taxable income. If you don't have much in Roth IRAs, it could be an option to do partial Roth IRA conversions early in retirement before required minimum distributions begin. You should also consider paying down some debt and adopting a simpler lifestyle. This will allow you to pull out less money from your other accounts such as IRAs and keep that provisional income figure low. The decision of when to start Social Security income should not be made in a vacuum. There are so many variables that need to be taken into account. Do you have a pension? What are the balances of your IRAs and 401ks? Are you going to have to tap into those to fund your lifestyle in conjunction with Social Security? When RMDs or required minimum distributions begin at age 70 and a half, how is that going to impact things? Do you have a brokerage account or Roth IRA that you could tap into, potentially pull from so that you can reduce that taxable income? Are you going to keep working? If it's past full retirement age, should you work and start Social Security income or delay it while you're working? Many variables to consider. We've tried to keep things as simple as possible by using spouses with the same age, but more often than not, that's not the case. And that can make things even more complex, especially when one spouse is grandfathered in under the old rules and a new spouse is subject to the new rules for Social Security. So if you do have questions, feel free to reach out either through the Contact Us page on our website or through our email and phone number. We would love to learn more about you and your goals and help get you pointed in the right direction. This is Aaron Parrish with Triad Financial Advisors. Thanks for watching.